One of the most controversial things when it comes to the investing space is to diversify or to not diversify. You have one camp of people that think diversification is for idiots, and the other camp of people think it is absolutely necessary. And in this video, I'm going to go into why I do or don't think it is necessary. Without further ado, let's get straight to it. Welcome. If you're new to the channel, my name is Matt Jimenez. I'm an entrepreneur who has worked with the greatest minds in finance over the last several years, and I'm here to pour into you guys everything they pour into me. Now, today's topic is diversification, and while it may be very controversial depending on what side of the fence you are on, whether you think it's smart or you think it's stupid, it doesn't matter. I want to speak about my own personal experience and why I believe that I actually should have been a bit more diversified within a particular asset class. Now, when we talk about diversification, yes, we need to look at the entire investment pool of your portfolio and ask yourselves whether you should or should not be diversified. Regardless of your answer, majority of people are still diversified. If you have cash and you have even one stock, you're diversified. You have cash and you have equities. When you look at a portfolio in this manner, now you could start assessing where you need to diversify more of your monetary energy. And while some people love to divvy it up and do portion of bonds, portion of equities, portion of currencies, commodities, cryptocurrencies, and so forth, I actually want to isolate a single portion of my portfolio, and this portion is the algorithmic trading side of things. And I want to ask myself, should I or should I not be diversified in this section? And if so, why would I do that? But before we do that, I actually want to pull up a very prominent figure in the world of investing, and he has a lot to say about diversification. And this person is Ray Dalio. Ray Dalio is one of the most successful fund managers on the planet to date, and he has a lot to say about the topic of diversification. Here I have Ray Dalio explaining his method of diversification, and he calls it the Holy Grail. If you don't know who Dalio is, Dalio started investing in 1975, and he launched Bridgewater Associates from his 2-bedroom apartment. And in the 40 years that followed, he grew his company to be the largest hedge fund firm in the world. Today, Bridgewater Associate manages $160 billion in assets, and Dalio has estimated net worth of approximately $18.7 billion, and it's probably changed by the time this article is written to current date. And now that you know a little bit of who he is and how much money he has involved, let's look at what he thinks about diversification. Dalio credits much of his success to a unique method of portfolio construction, one he developed after some painful lessons about diversification during the early years of investing. Now, traditional diversification focuses on protecting returns through purchases of assets in different classes. For example, majority of people, this is what they will have. They'll have stocks, bonds, and cash. Those who are comfortable with high risk, high reward strategies focus on the equity side, while investors who need more stability increase their bond and cash holdings. Now, here's the problem that he says. The problem with this method of diversification is that it can impact returns. The safer asset classes can't guarantee the sort of income that stocks do, and they don't increase in value at the same rate, which we all know because bonds don't really increase in value because they're just backed by an interest rate that the government will pay you back potentially. Meanwhile, stocks are being pumped and pumped with all this endless QE that's happening and just fluffing up asset classes to new highs after new highs after new highs, meaning if that was in your portfolio, you would be reaping a large portion of that upside and overall increasing your quote-unquote wealth. One thing that I found quite interesting is he calls it the Holy Grail. And while you may or may not be religious, that is not the point that I'm trying to make here. But the point I'm trying to make here is the wisdom in the Holy Grail of investing. And why do I say that? Because actually in the Bible, it says something along the lines of this. Here in Ecclesiastes 11, the Bible says, "Invest in 7 ventures, yes, in 8. You do not know what disasters may come upon the land." So why do I even bring this up? Because there is wisdom in all of these texts. And if the Bible, one of the oldest written books ever and one of the only books that are still valid to this date, even says to be diversified when it comes to allocating your wealth. It says 7 to 8. And Ray Dalio calls his diversification portion of an investment portfolio the Holy Grail. Now, while you may or may not find that interesting, I just thought it was a cool piece of evidence that maybe we should be a bit more diverse than we think. Now, with being diverse, it's very important to understand correlations, because if you are diverse, but the assets that you are holding are heavily correlated, then you're actually not diverse. For example, if you buy the S&P and then you buy some large cap equities, quote unquote stocks, then that doesn't mean you're diversified. And that just means you have more invested in the equity side of things, because the S&P is correlated to how well the stock market is doing overall. So if you're holding individual stocks plus the S&P, those are heavily correlated. So if the S&P goes down, more likely than not, your stocks that you bought would be going down as well. But this video, again, is not for any of that. What I want to talk about is correlations within the currency markets. Because yes, there's a multitude of pairs that these algorithms trade, and with a multitude of pairs comes a multitude of different variables of correlations. And on this chart that I have right here, this is the Forex correlations across a broad of currencies. And this is right on my FX book, guys. You could easily go ahead and look this up. And whatever it is that you're trading, if you have an algorithm or you're doing it manually, it doesn't matter. It's very important to understand these things, because if you don't, you may find yourself in back-to-back losing trades because you're just finding yourself on a double-sided loss of heavily correlated pairs. If you go to the far right of this chart, there's a filter. You could just go ahead and click in the pairs that you trade or don't want to trade, and you'll see the correlation amongst them. See, I just moved one out of that basket because I don't trade that, nor do I trade this, nor do I trade that, or that, or that. So that will change everything on the back end over here. And now I could see which ones are heavily correlated. Of course, the higher the percentage, the more likely they are correlated. And what you're looking for here are things that are not correlated, because you don't want to have a lot of exposure to things that are heavily correlated. Because let's say you're in a long position on AUD USD and a long position on AUD CAD, and both of those pairs are heavily correlated at 90%. So if you're in a long position and it's the wrong position, now you're just taking double the loss. Typically, if you're long that, you'd want to find something that'd be the opposite of that. So if you're long AUD USD, chances are you probably would be in a safe spot if you were long Euro AUD, because they are inversely correlated at negative 84%. Now, the reason why I even run you through this is because what I'm going to be doing moving forward on my softwares is, after a month or 60 days of tracking the data, I'm going to be looking at the most profitable pairs. And from those profitable pairs, I'm going to extract the non-profitable pairs. And I'm going to look at the correlation between all of them. And that way I'll have a better understanding of what pairs I want my algorithm to trade and what not to trade, and what pairs to look out for if I'm heavily in multitudes of positions that are heavily correlated with one another and they're going in the wrong direction. I'll have a better gauge on what to do and why things may or may not be working out. I believe this will help me with my profitability long term. And keep in mind, I said I will be removing the lesser profitable pairs, which will now change the returns on how much I'll be making, which I'm okay with. But what I'll do to help compensate that change in return is I'll increase the position sizing on the more profitable pairs. Now, guys, if you're listening to this, none of this is financial advice. None of this is something that you should take and go do in your portfolio. I do not condone any of that. And the only reason why I publicly speak on these things is to show you guys exactly what I'm doing in my own personal portfolio. This has nothing to do with anyone else. So before anyone takes this as advice, it's not advice. This is for your entertainment, actually. Now, with all of that said, let's look at the algorithms that I have funded at the moment to show diversification. And the reason why I'm going through these is because if I was diversified last month when we had that massive sell-off from the yen, and I wasn't in heavily correlated positions that exacerbated this massive drawdown, then I probably would have been in good standings. But more importantly, if I didn't have all my money in one singular algorithm and I was diverse amongst 3 or 4, then I most likely would have been completely fine, recovering from a minor loss. Reason I say that is because during the time of that massive sell-off, I actually had the Diio Bot up and running, and I want to show you guys exactly what it looked like. So here it is, the Diio Bot, and it's quite ironic that I just spoke about Dalia in the beginning of this video, and now I'm showing you my Diio Bot. But now I bring this up to show you during the time of the massive yen event that caused lots of damages in my other account, this account only experienced 0.83 drawdown. So essentially nothing happened to the account. And in fact, the account is still running to this date. And so far the account has done 3.33%, and it is only the 14th of August so far. Currently, I'm up $395 on an account that I started with $9,954 with. So essentially, I am up 3.97%. So do you see how me being diverse allowed me to actually keep this investment going? Meanwhile, the other one blew up. Now, the other thing I'm going to be doing is I'm going to be funding a gold digger algorithm. Reason being is because during the month that I had the biggest loss I ever had, this algorithm actually did completely fine. And in fact, it profited 10% during all of the madness. Now, if I had diversified that $50,000 amongst the Dalia, the gold, and even the Fed, I would be in a lot better position right now than I am. But this is a journey and it is a learning experience. That's part of a journey. You learn as you walk. Now, with all that being said, I hope that you found massive value from this video. And if you did, please leave me a like, comment, and or subscribe. And like always, my friends, peace.